Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Monday. It's May 2nd, and boy, oh boy, summer is right around the corner. I was just thinking last night, where did this year go, right? I just don't know where this year went. Anyhow, it's about 7:50. Market's going to open up in an hour and 40 minutes. And as you can see here, we're fairly stable. I mean, this is not a major move considering Friday we lost more market cap in a month than we had as of last month. We lost more market cap last month in the major indices than we did since 2008. But I actually think most of it is behind us, and I'll explain to you why. Pay attention to the momentum level studies I'll do for you today. They'll show you quite a bit. As far as this week is concerned, we've got a pretty busy week. We've got FOMC meeting begins tomorrow, which means trading action, especially on the bond market, will be subdued. Then we've got international trades in goods and services, which is a big report. We've got the ADP private report, which can go either way. But then we've got the big daddy, the FOMC, where the Federal Reserve will announce whether they're going to raise rates a quarter, half, or 3/4 of a basis point. Based on what I am seeing, based on what I'm seeing in the bond market, and I just wanted to show you the bond market. This has been the bond market over the last 2.5, 3 weeks. Let's see, 1, 2, 3, 4, 5, 6, 7, 8. Yeah, 2 weeks. And as you can see here, with all of this turbulence in the stock market and ahead of the FOMC and GDP last week, we haven't moved down, which is telling us that the long bond, which has been going down, I mean, nonstop, relentlessly, hasn't been going down, which means the long bond is not so sure and confident that the Fed is going to aggressively raise rates. It's what it's telling us, for now at least, that the majority of the rate hikes, because remember, bonds go down, interest rates go up, are priced into the market, or that the future raises are not going to be as strong as the Fed is anticipating, because that's in the bond market. Now, theoretically, of course, we can break down and go lower, and I think we will ultimately. But the fact that the slowdown on the downslope is happening is a very, very good sign that the long bond may be overdone to the downside, especially in the short term. Now, put to call ratio. This measures the number of put buyers compared to call buyers. It continuously is moving into the 130, 133 level, which is the highest level we've seen since 2018. This is COVID right here. We haven't even gone this level since COVID. That's a major factor. Another major factor, Nasdaq. This is the number of stocks in the Nasdaq trading below the 50 or above the 50-day moving average. This is COVID right here. This is 2018. So, I mean, we could theoretically go down, but we are really near these. Look at where we're at right now. Kind of on the low end of things. Really on the low end of things. So that's the number of Nasdaq stocks above the 50-day moving average. Look at it above the 200-day moving average. This is the big daddy. This is real meaningful because this is COVID right here. And this is 2018 right here, interest rate hikes. We're below those levels on the 200-day line. So in my opinion, in my humble opinion, this market is getting ready to go higher, scream higher. And anyone who's thinking the market's going to crash, well, it started back in December of 2020, and it's been slowly coming down. I mean, even the ARK stocks are like basing. The point I'm making is, for anyone who's looking for a market to crash, we have been going down. We've been going steadily down. So I don't know if we're going to have a major crash from here, but if we do, it would be kind of like falling from a third-story balcony instead of a 50th story. The landing down, or maybe it would be kind of like somebody taking you down 5 feet above the ground, and then letting you go. It wouldn't be a big crash because we're already down here. And again, this is very meaningful, and this isn't noise. This is the 200-day moving average. This determines if markets are bull or bear. So the fact that you have less than 20% of stocks in the Nasdaq, that's 1/5 trading below the 200-day line. Just to show you, this goes back all the way to 2006. It doesn't happen very often, and we're there. So to say that we're going to go lower or crash from here just wouldn't be very, very credible. Now, volatility is still high, but we're not as high as we were earlier this year. All right, and earlier this year we didn't really have a much of a gyration in the market compared to a few years ago. So if you look at COVID, if you look at the COVID run that we had, let's see here. This is COVID right here. We went to 66. We're right now only at 34. So I think we're going to revert lower. I don't see much of a reason to panic right now, especially in light of the fact that most of these earnings are already out. Let's talk about global economy. And remember, the reason the Nasdaq 100 and the reason you're seeing such huge violations or ranges is because we had earnings on the stocks with the biggest market cap. If you take a look at if you look at the QQQ right now, you will see that we're right at that level, that bouncy level. We're below that level actually, and we're showing divergence. Look at that here. Divergence typically resolves itself. Higher, lower. That's a reason for a bounce. So this is showing me that, and the fact that we can't get below 30 here is showing us that this market is just grossly oversold. So the bottom line is I'm expecting a nice big bounce. Maybe not a bull market from here, but this continuation of this chop to continue quite a while longer. And again, divergence is a very strong indicator that this market's going higher instead of lower, especially in the short term. Now, looking at global economy, let's talk a little bit about global economy. There's a mess happening in the world right now. Oil prices lost $3 a barrel as energy minister said he's going to discuss Russian supply issues and sanctions. I think oil is going to stay around these levels for quite some time. A report showing pandemic lockdowns have hurt factory activity in China, main regional driver of growth. That's a big concern. Remember how this whole COVID started with Chinese lockdowns. The monthly purchaser managers index, this is released over the weekend in China. They released a lot of their news over the weekend, fell to 47. That means it's below 50. Anything below 50 shows contraction. I mean, it's not 30, but it's not great. This is a new concern now. And I mean, look, folks, it was just a matter of time. I mean, we've known about this China COVID problem now for a couple of months, so it would make sense that their activity would be muted. The COVID outbreaks have impacted their factory activities and demand. Again, we know that already. China's most populous city, Shanghai, spent most of April in a lockdown, and April is supposedly a good month for stocks. The EU energy ministers were to meet to discuss Russia's decision to cut gas supplies to Bulgaria and Poland and debate sixth round of sanctions over Moscow's war on Ukraine. The energy minister were planning to look at what steps to take if Russia ramps up its pressure by cutting gas supplies to other countries. Well, folks, I hope you could see that these sixth round of sanctions are not doing anyone any good. On Friday, steep losses of tech stocks pushed the S&P down 3.6%. Nasdaq finished down 4%. April, 13.3%, biggest loss since 2018, which is another reason why I think the market is ready to go higher. I think most of the downside is priced in. Investors have been reviewing financial results from big techs, which I'll talk about in a minute. Industrial firms, retailers, and some disappointing results. Our outlook for Apple, Google is what caused or fueled, and Amazon fueled last week's rally. Sell-off. They're also watching for next steps in Federal Reserve inflation. That's coming out this week via the FOMC. Now, in terms of, you've got earnings, a lot of earnings this week. This week, we're starting to get broad, which is good. It's not as concentrated in tech. You've got Devon Energy, which is one of the biggest energy stocks. You've got CVR Energy, Clorox. You've got Global Payments. You've got Interpret Potash. That's going to be an interesting one. MGM International, Moody's, that's going to be very important. Mosaic is reporting $2.41 a share. That's going to be big. Semiconductors, it's getting broad. The big highlight for the first part of the week is going to be tomorrow. It's going to be AMD and Pfizer. All right, those are going to be the big reports. Now, AMD right now, if you look at AMD, it's not looking all that great. I mean, it's looking terrible. And Pfizer is actually looking pretty good. It's actually looking better. It's at the 200-day line. Most stocks are at the 200-day line right now. But the bottom line is the big stocks for the first half of the week you want to pay attention to is AMD and Pfizer. And again, you've got a lot of stocks reporting today. either before the open or after the open, and it's becoming a mixed bag. This will give us a good indication of where the broad market stands. But you've got NXP Semiconductors, On Semiconductors, again, Moody's and Mosaic, MGM. You've got Expedia. That's going to be very interesting to see what they're reporting. You've got Clorox, Devon Energy, one of the biggest energy stocks. Avis Budget Group, this will be important. Apartment Income REIT will be important. Bottom line is, after today, we'll have a good understanding of where we are. Folks, I think stocks are going to go up this week, but let's take it nice and slow. We've got a lot of upside potential. Let's not jump into things, all right? Keep your eye on the news, especially the GDP. And again, try to focus on other sectors than large cap right now, although I think Nasdaq is going to have a nice big pull up to the upside. Now, folks, before we get too serious about this analysis, I've got something important for you. The markets were extremely volatile last week. That's an understatement. And a lot of traders are frustrated because they have no idea the way things will move each day. That's why Chuck and I are going live today at 1 p.m. Eastern Time for an urgent market briefing. During the special presentation, attendees will not only discover one of the boldest predictions of Chuck's career, but also claim a brand new trade signal, including a stock, an option for free. You don't want to miss this out. And again, momentum levels are showing markets are ready to go higher. All that and more just for joining us today for an hour packed with meat and potatoes trading strategy you need to see live. Click the link below and learn more about Takeoff and access today's live event. Tomorrow, strongest sector, strongest stock, weakest sector, weakest stock. Maybe I'll even give you a couple of ETFs. And remember, market momentum levels are near the bottom, not near the top. This is a time to start getting greedy, not defensive. Just saying. Follow the link below. If you can't find the link, go to the YouTube Wealth Press channel. It's in the descriptor. Bye, guys. Send me some emails. I want to hear from you. It's been a while. Bye.